A high multiple and either prudent conservatism or frank assessments of the reality of the macroeconomic environment go together like oil and water. Two breakout stocks holdings have seen some wild price fluctuations this week after their earnings calls. Mr. Market's wild ride is making Mr. Toad's wild ride seem like a casual Sunday morning drive through the countryside. On Tuesday, a lot of communications reported inline second quarter results, better than feared, but it was management's commentary on tighter budgets and increasing price sensitivity at some of their customers that was scaring the fast money out of the stock, despite overall bullish commentary and still strong order trends. Management commented they continue to have a large backlog and a strong pipeline, and that the second quarter's book-to-bill ratio was greater than 1. Margins expanded, and the company still has $4.75 per share in cash and no debt. I believe a lot represents an excellent way to play the mobile megatrend's evolution as it stands to benefit from the monetization of the flood of smartphones in the market and the corresponding data usage. It's clear that the company continues to execute even in a very difficult environment. Clearly, management's frank assessment of the macroeconomic impact on their sales pipeline is scaring some investors out of the name because they feel that a lot will be unable to withstand these pressures. I think that should not be the key takeaway from the conference call. The stock dove by 12.8% on Tuesday intraday, only to close 40 basis points lower on the day. A wild ride indeed. On Wednesday, it was Sourcefire that was taken out behind the shed, as the stock was trading down about 16% when I taped this. So let's get to the details. Sourcefire delivered strong second quarter results, beating on the top and bottom line, raising their full year 2012 revenue guidance to growth in the high 20%, but guided to third quarter revenue of $54 to $56 million with EPS of 19 to 21 cents versus consensus at $55 million and 22 cents. Is that worth a 16% blow-off? Clearly, the stock trades at a sky-high multiple at 43 times its 2013 earnings, so sell-off is understandable, but 16% seems overdone. Margin growth continues to be muted by management's investing in building out its sales team, channel distribution, and product development initiatives. These are the actions that a company takes when it sees opportunity, not when it's worried about a decline in business and then looks to ramp down its expenses. Management noted that they're still a small player in Europe, and therefore they haven't been affected by the macroeconomic malaise over there. Sourcefire should continue to command a security pure-play premium. Its business is clearly on fire, and new product introductions will likely continue to fuel growth in 2012 and beyond. Bottom line, sometimes when the Mo crowd gives you lemons, you have to make lemonade.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're getting